Hello everyone, welcome to the Stock Minds web channel. In Q2 2025, Eli Lilly Company, NYSE LLY, delivered a remarkable financial performance, showing explosive growth in revenue, earnings, and free cash flow. Despite these strong numbers, the stock faced volatility due to a clinical trial setback for its oral weight loss drug. Yet analysts remain bullish, citing robust fundamentals and promising guidance. In this video, we will dive into Eli Lilly recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Eli Lilly. Founded in 1876 by Eli Lilly, a pharmaceutical chemist and Union Army veteran, Eli Lilly Company has grown into a global pharmaceutical powerhouse headquartered in Indianapolis, Indiana. Today, it operates in approximately 125 countries, offering a wide portfolio of drugs from early insulin products, antidepressants like Prozac, to modern GLP-1 therapies such as Mounjaro and Zepbound. The company has become a leader in metabolic and neurological treatments, underpinned by a vast research pipeline and continuous innovation. Eli Lilly financial performance. Eli Lilly delivered exceptional financial results in Q2 2025, with revenue reaching $15.55 billion, up 37.65% from $11.3 billion in Q2 2024, and EPS surging 91.77% to $6.29 from $3.28. On a trailing 12-month TTM basis, revenue climbed 36.83% to $53.25 billion from $38.92 billion, while EPS increased 88.31% to $15.29 from $8.12. Free cash flow per share, TTM, rose sharply to $5.42 from just 28 cents a year earlier. Profitability remains robust, with a gross margin of 82.64%, net margin of 25.91%, and free cash flow margin of 9.17%, alongside strong returns on assets of 16.55% and returns of equity of 86.29%, though the company carries a high debt-to-equity ratio of 2.18. Over the past 5 years, Eli Lilly has grown its revenue at an 18.8% CAGR and net income at 19.5%, while free cash flow has remained stagnant. The company has grown consistently and is still projected to grow rapidly in the future. Eli Lilly Fiscal 2025 Financial Forecast. Looking ahead, analysts forecast 2025 revenue of $61.52 billion, a 36.58% increase over 2024, and project non-GAAP EPS of $22.69, up 74.65% from $12.99 in 2024. Analysts give consensus buy rating with an average price target of $907.67, implying a 42.89% upside, and a high estimate of $1,190, suggesting potential gains of 87.33%. LLY stock price performance and valuation. At the time this video was created, the stock was trading at $635.22 per share. Eli Lilly's stock has declined 28.1% over the past year, underperforming the S&P 500's 19.2% gain in the same period, largely due to high valuation in the past. However, over the past 5 years, the stock has surged 323.2%, far outpacing the S&P 500's 88.8% rise, reflecting the company's long-term growth strength. Eli Lilly offers a modest dividend yield of 0.94% and trades at premium valuation levels, with a PS/TTM of 10.54 and a forward PS of 9.13. Its non-GAAP PE/TTM stands at 41.68, with a forward PE of 29.17, while the PFCF/TTM is notably high at 116.74. Based on Fiscal.AI data, Eli Lilly's forward PS and forward PE are currently below their 5-year averages. In the past, the stock traded at a significant premium, but its current valuation is relatively low, suggesting it is now priced more reasonably. This may indicate potential undervaluation, especially given that Eli Lilly's business performance remains strong and is projected to grow rapidly in the future. Eli Lilly growth potential. Eli Lilly's growth outlook stays robust, driven by several factors. 1. Dominant market position in the revolutionary GLP-1 and incretin market. Eli Lilly commands a leading position in the rapidly growing GLP-1 and incretin therapy market, a major pharmaceutical opportunity. Its U.S. market share for incretin analogs reached 57%, up 3.8 percentage points from the prior quarter, amid a 41% year-over-year market expansion. This leadership is driven by blockbuster products Mounjaro, with $5.2 billion in Q2 sales, 68% growth, and Zepbound, generating $3.38 billion, 172% growth. Combined, these tirzepatide-based therapies earned $8.57 billion, underscoring Eli Lilly's superiority over competitors like Novo Nordisk. Clinical data from the SURMOUNT-5 trial highlights tirzepatide's 20.2% average weight loss, surpassing semaglutide's 13.7%. Enhanced manufacturing capacity, increased 1.6 times in early 2025, supports scaling demand. With only 8 million patients currently treated out of a 170 million potential population, this dominance offers strong pricing power and sustainable revenue growth. FDA's recent resolution of tirzepatide shortages further solidifies the company's competitive advantage. 2. Expansive pipeline innovation and diversification strategy. Eli Lilly's robust pipeline fuels its long-term growth beyond GLP-1 therapies, supported by a $3.34 billion R&D investment in Q2 2025, a 23% increase highlighting strong innovation commitment. The pipeline's highlight, orforglipron, is an oral GLP-1 receptor agonist delivering over 12% weight loss in late-stage trials, poised as the first needle-free weight management option with the 2026 launch expected. Beyond metabolic diseases, Eli Lilly advances donanemab Kisunla for Alzheimer's, with FDA approval and improved dosing, reducing side effects. Its oncology portfolio grows via strategic moves, including investments of $60 million in Actis Oncology, $140 million in Radionetics, and the $1.4 billion Point Biopharma acquisition. The company also develops retatrutide, a promising triple hormone agonist for obesity, and broadens into pain management through the SiteOne Therapeutics acquisition. This diverse pipeline covers neuroscience, cardiometabolic, oncology, and immunology, balancing risk while maximizing growth potential. 3. Strategic market expansion and access initiatives. Eli Lilly's market expansion strategy drives growth through geographic reach, new indications, and innovative access models, broadening its addressable markets. The company plans to launch Mounjaro in key emerging markets like China, India, Brazil, and Mexico by 2026, targeting large populations needing advanced diabetes and obesity treatments. Recent FDA approvals for tirzepatide, including obstructive sleep apnea, expand its therapeutic use. Potential Medicare coverage of Zepbound could unlock millions of cost-sensitive patients, increasing access and predictable reimbursement. LillyDirect's 1.1 million Q2 prescriptions showcase a direct-to-consumer channel that enhances patient access and data insights. Strategic pricing negotiations, especially in Europe, position tirzepatide as a cost-effective alternative to competitors, accelerating adoption. Ongoing label expansions investigate tirzepatide for cardiovascular risk, chronic kidney disease, and metabolic dysfunction-associated steatohepatitis. These diverse initiatives establish multiple growth avenues, reducing dependency on single markets, and strengthening long-term revenue and leadership. Risks to consider. While Eli Lilly's story is strong, we should be mindful of potential risks. 1. Competition and market pressure. Eli Lilly faces intense competition in the pharmaceutical industry from both well-established firms and emerging biotech companies. This rivalry, particularly in vital areas such as obesity and diabetes treatments like Mounjaro and Zepbound, can result in pricing pressures and potential market share losses. Maintaining leadership in these segments requires continuous innovation and strategic marketing amid evolving competitive dynamics and patient needs. 2. Dependence on key products. Eli Lilly depends significantly on a few blockbuster drugs, especially Mounjaro and Zepbound, which generate a large share of its revenue. If these drugs encounter increased competition, lose formulary access as occurred with Zepbound's removal from CVS plans, or deliver clinical outcomes below expectations, the company's revenue could suffer. Such risks highlight the vulnerability of Eli Lilly's financial health to the performance and market acceptance of its key products. 3. Regulatory and approval risks. The pharmaceutical industry is highly regulated, and delays or changes in drug approval processes can significantly impact the timing of new product launches, affecting revenue growth. Regulatory challenges create substantial uncertainty for the company's drug development pipeline and commercialization efforts. These hurdles can slow down market entry, increase costs, and pose risks to achieving forecasted sales, making regulatory approval a critical factor in Eli Lilly's overall business success and future growth potential. Conclusion: Eli Lilly's Q2 2025 results underscore its strength as a high-growth, innovation-driven pharmaceutical leader with exceptional revenue, earnings, and cash flow growth. Despite recent share price volatility, its dominant position in GLP-1 therapies, strong margins, and robust pipeline support a positive long-term outlook. Valuations, while premium, are justified by the company's growth trajectory and analyst forecasts pointing to substantial upside. For investors seeking a blend of innovation, profitability, and market leadership, Eli Lilly remains a compelling long-term investment opportunity. But remember, this is not a financial advice. What do you think about Eli Lilly? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching, and see you in the next one.